Hello, everyone, and welcome back to our weekly tanker market podcast. Today, we are going to dive deep into the latest trends and developments in the tanker market for week 49. I'm your host, Trisha, and today we have Sandesh, an expert in maritime shipping and tanker markets. Welcome to our podcast, Sandesh.
Thank you, Trisha. It's great to be here.
Alright then, firstly, let's have a look at the state of the VLCC segment for last week and its recent developments. So Sandesh, can you shed some light on what's been happening in the VLCC market recently?
Absolutely, Trisha. The VLCC or the very large crude carrier segment has been experiencing some interesting dynamics lately. Let's break it down step by step, understand the current scenario. First, at the beginning of the last week, we saw a slight increase in activity levels within the VLCC segment. This uptick was mainly because of the December cargoes were expected to be covered. When cargo levels are anticipated to be fulfilled, it usually leads to a modest rebound in the market. So there was some optimism that the market might be turning around. However, despite this initial positive movement, the overall market remained weak. For the VLCC market to truly reverse its trend and move towards a stronger position, we would need a higher volume of cargoes. Right now, the volume isn't sufficient enough to drive a significant change in the market sentiment. Having said that, Trisha, one of the key factors contributing to the market's weakness is the demand dynamics, and those were especially from major players like China and India. These countries are primarily sourcing their oil needs from Russian oil. The shift in demand patterns has led to a concentration of vessels in the VLCC segment, and that added more pressure on the market. Let's shift our focus a bit and let's talk about ex-MEG and ex-WAP segment. So what ex-MEG and ex-WAP means? It's a Middle East Gulf and West Africa segment. So in the ex-MEG segment, the market fundamentals remain steady and ship owners are showing a preference for keeping their vessels in the Atlantic region. The ship owners seems hesitant to commit to a longer voyage due to consistently low earnings in the market. And moreover, there has been an increase in vessels ballasting into Atlantic. At the surface level, there is a lack of fresh activity. And if we talk about the ex-Brazil market, it also shown some weakness. In the VLCC market, there were many transactions, those being concluded privately. And having said that, this means they are not publicly visible. And that's why they have a very little influence on the overall market sentiment. Looking at the ex-USG segment, the market remained soft throughout the last week. And this softness was driven by subdued activity levels and overall weakness in the global VLCC market. As the week progressed, we have witnessed some fresh testings on the US Gulf Coast and Brazil loading routes. And these routes showed a mixed freight movements, and it indicates that while some areas were seeing better rates, others were not performing as well. And Trisha, the sentiments on the West Africa East run also softened. That affected freight rates on the Brazil East route. Now let's talk about the Baltic rates. We have dirty tanker rates, which are the key indicators in the VLCC market. And for example, TD2 and TD3C, those are the benchmark. The both are decreased by 5.51% and 4.54% week on week. And it settled on world scale 43.75 and world scale 43.1 respectively. Similarly, the another benchmark TD15, it's also decreased by 6.15%, while the TD22, it also decreased by 2.04%. While TD22 stood at 7.16 million week over week, and it was a lump sum freight. Overall, this decrease reflects the overall softness in the market.
Well, that is indeed an interesting flow for the VLCC segment. Now, can you also shed some light on what's happening in the Suezmax market?
Well, Trisha, Suezmax segment was quiet last week and rates slightly softened due to subdued chartering demand and limited cargo inquiries. And it was specifically on eastbound routes. The oversupplied VLCC market added more pressure on Suezmax. Although there was an increase in fuel oil loading activities in the most part of the world, there were competition from VLCC tankers and they erode the Suezmax market share. We saw by the end of the week rates remain steady and it was influenced by a stronger and more active Atlantic market. In the ex-WAP segment, that is West Africa segment, The last week began with the firm rates and it was driven by a surge in fixtures, and despite limited visible activity, the sentiment remains slightly firm and the expectation of stability or a potential uptick as cargo levels were monitored. In the last midweek, rates held steady and it was at the last done levels. But important thing is that it was supported by balanced tonnage activity. While we moved ahead towards the end of the week, there was subdued activity in the both WAF and MED regions, that is Mediterranean region. But the strength in the US Gulf market has provided much needed support. Now, when we talk about the Suezmax segment, let's talk about the Indian PSU segment. The last week they have quoted one cargo and it was done ex-MEG West Coast India, covered at 98.5 world scale.
Well, now that we have looked at the VLCC and the Suezmax segment, what is happening in the Aframax segment? Could you also shed some light on how it performed last week?
Well, in the Aframax segment, the market saw minimal activity. And when we say minimal activity, some private fixture dominating early on and overall sentiments remained constrained. While we're talking about the freight rates for the eastbound voyages, it remained relatively firm and it was due to a limited supply of quality tonnage. However, the rate delta, or we can say the difference between Aframax and Suezmax, they were stayed consistent. By the last midweek, activity level hadn't shifted significantly. With owners, they were mostly favoring premium opportunities in the West. Towards the end of the week, the market showed sign of gaining momentum with tight supply conditions, hinting at a potential growth, though rates remain steady overall. In the SEA segment, the market remained quiet with limited inquiries and ample vessel availability, and it puts downward pressure on rates. Well, despite a strong activity for short-haul voyages, overall sentiment stayed soft due to sufficient supply matching the loading demand. Now, the rate gap between LR2s and Aframax for routes to Southeast Asia narrowed, and it potentially offering a upward momentum for Aframax rates, but only if the trend persists. Overall, I would say that the market showed limited movement and it continued subdued sentiments.
Alright, Sandesh, now let's shift our focus to the CPP market and have a look at the LR1 and the LR2 tanker segments. Well, the market has seen mixed developments here with some sharp rate declines and intriguing geopolitical factors. So, could you break down the state of the LR1 and the LR2 segments for us last week?
Certainly, Trisha. The LR1 and LR2 segments have been navigating some challenging and dynamic conditions recently. If we want to go in-depth analysis, let's start with the LR2 segment. Last week, we have seen the AG Japan TC175, that is the benchmark route. It saw a notable drop in freight rates, and the rates were around 110.33 world scale week over week. And if you calculate that, there was a 8.35% decline, which is a quite significant, I guess. Corresponding time charter equivalents, they were also fell sharply. They were down by around $3,500 per day, and that drop is around 20.75%. So they were settling at around $20,000 per day. This decline reflects the mounting pressure on larger clean tankers like LR2s, where the subdued demand and increased competition have weighed heavily on rates. While in LR2 segment we saw rates getting dropped last week, we have a kind of a contrast sentiments observed in the LR1 segment. The rates were dropped, but there was a very mild decline. The world scale rates dropped just 0.31 points, and those were settled at around 111.88 world scale week over week. Now, if you saw the drop, it was less than 1%. And even the TC, there was a drop, but it was also marginal, just $120 per day, or even less than 1% week over week. While this is a less severe than what we have seen in the LR2 segment, it still highlights that the challenges faced by the owner were present even in the LR1 segment also. Interestingly, while the larger tankers like LR2s faced steeper declines, the smaller MR segment fared much better. And we have drawn this conclusion while we have compared the historical freight rates. So let's, for example, on the Sikka Japan route, that is TC1235 UK route, freight rates firmed by 6.12 points world scale, and they were settled on around 125.81 world scale week over week, and it reflects around 5.11% increase. So, there was a reflective moment in the market where we saw larger tankers LR dropped significantly. Then we have seen LR1 where a mild decline, and then we are seeing MR which is growing significantly. So this suggests that the smaller tankers operating in a niche trade lanes are currently benefiting from stronger fundamentals compared to their larger counterparts.
Well, that's indeed a thorough analysis, Sandesh, and it's definitely fascinating how interconnected these segments are and how external factors like geopolitics and trade policies play such a pivotal role. Well, thank you for sharing these insights. And on that note, let's move on to the AG Chiba and Houston Chiba routes. Well, the rates on these routes are stable or softening, but there are factors at play that could shift the dynamics. So, could you provide an overview on these markets and how possibly the scenarios we could see in the near future?
Absolutely, Trisha. Now let's start with the AG Chiba route. The freight rates here has held steady at $50 per metric ton. And this stability reflects a balanced supply and demand in the region. But it is for now. Now, Indian public sector undertakings, or we called it as a PSUs, they have been particularly active in November. We can say that because we have seen some strong spot liftings in the month of November, and December is shaping up similarly. Until now, we have seen around 6 spot fixtures already on the books. But having said that, the important factor in the freight rates is the tonnage. However, the available tonnage in the Middle East Gulf for the final decade of December looks abundant compared to the anticipated cargo volumes. And this surplus could keep freight rates on the BLPG1 route under pressure in the short term. And that said, there is an interesting possibility. Let's say if some of this excess tonnage, those ballast westward, they reduce the pool of available vessels in the east, and with that the dynamics could change significantly, because a tighter tonnage list in the Middle East Gulf would create an upward pressure on freight rates, particularly for the BLPG1 route. Now let's focus on the western market. Here in the Houston Chiba route, it is currently a softer with rates hovering around $101 per metric ton. And this reflects the subdued activity levels. For context, the 1st January cargo was covered early this week, but only a few fixtures have been concluded since. As of now, there are 4 vessels available for December loading dates out of the US Gulf, including one that is prompt open. The most recent fixtures for this route was done in the low hundreds, which shows a market still favoring charterers. However, we may not see much more downside from here, and owners with the vessels availability in January are unlikely to accept rates they perceive as too low. Instead, they may explore alternative routes or markets to find a better earnings. And this strategy could put a floor under rates, even in lead to some rebound if cargo activities pick up. Now, summarizing this, the larger picture here, Trisha, is that while this market appears stable or soft at the moment, they are highly susceptible to shifts in the vessel availability and cargo flow. For example, if excess MEG tonnage heads west, it could tighten both eastern and western markets. Conversely to that, if January demands out of the US Gulf, that is entire USA demand, it proves weaker than expected, then the rates on the Houston Chiba route might stagnate, and they could stagnate further or see a limited recovery.
Thanks, Sandesh. It's definitely clear that even a stable market requires close monitoring because of how quickly things can shift.
That's right, Trisha. In this industry, staying ahead of this shift is essential for making informed decisions.
Absolutely. We'll continue keeping a close eye on these developments. And thanks for the detailed breakdown, Sandesh. Now, to all our listeners, do not forget to share and subscribe for more updates on tanker markets. Until then, navigate safely and stay